Welcome back to the second session of my second class of the psychology of FinTech. I am Dr. Finance Andy Kim, and we're talking about the efficient market hypothesis. Well, you must have learned about it in your financial management, but after vacation, right? International travels and having some fun, you're destined to forget it, right? But it's okay. You just have to brush up our memories, right? And then the thing is, efficient market hypothesis, what was that about? I told you all these about this, price versus value thing. And then whether the price in the market really reflects the information about economic fundamentals is a question, okay? Efficient market hypothesis says that it reflects it. The price reflects the information. Yeah. Eugene Fama is the one who won the Nobel Prize in 2013 for his papers and contribution, starting from his papers in 1970. You can read it about the definition of the EMH, right? And then he looks like this, and value, true value. How can we estimate it? This formula. More complicated one is over here. Don't get bothered too much about this mathematical notation. Yeah, the simple idea. Everything boils down to two things. What? Cash flow and risk. Risk in the name of the discount rate. Okay? Now, EMH does not say anything about which expected return or cash flow to use in this model. Okay? Expected cash flow of Tesla. Do you know how much they're going to sell next year? How sure are you? Even who is it? Elon Musk may not be sure about how many units will be sold next year. Okay, we're just guessing it, an expectation. And 10 years down the road, good luck. And then how about the discount rate? Okay, high risk, high return. And then the beta was our measure of systematic risk in CAPM. Going forward, what is the beta for the Tesla? You have regression beta of Tesla, but that's a history. What about going into the future? Out of sample, do you know, right? And then moreover, even if you use that regression beta in reality, is CAPM the only model that is justifiable? Okay, that should be used over here. Remember, CAPM has just one factor, market factor, right? Can there be multiple factors? Right? Doesn't say anything about it. What should be used over here and over there? And we are just beauties in the eyes of the beholder, and then we are trying to estimate it with some errors, right? So that's what we are doing it. And let's believe that the price is equal to the true value in the long run and in the short run, and on average. It's not saying that one specific stock, each and every single stocks are reflecting the price is reflecting the true value for each and every stock. No. But on average, it should be. And they say, okay, Eugene Fama says, the price behaves as if it reflects all the information. As if. He never says that it really reflects it. Because in the first place, there's no royal road to estimate this thing. Okay? It's not set up, okay, scientifically. It's not there. Because it's the future. Nobody knows. Okay? That's the reality. But let's believe. And then if you look at the price behaving with respect to the information, okay, like news announcements, and with respect to the news announcement, how does the price behave after this news announcement, on the day of the announcement? It behaves as if the price correctly reflects all these news and this information. And then So that's the argument of EMH, guys, right? And then, three sets of information. We have to distinguish the level or the degree of EMH. So I said the price reflects all the information, but what kind of information are you talking about? So we can classify those information into roughly three classes. One is past information, especially about the price itself, the track record, okay, of the price and trading volume, and the historical information, okay? The second is publicly available information, like the disclosures, SEC disclosure in the United States and financial supervisory disclosure in Korean setting. Okay, the companies, when they do some earnings announcement, okay, after a year, they have to report how well or badly they did over the last year. They have to report it to the shareholders, right? Earnings announcement, that's what we call it. Or whenever there is some important corporate events like mergers and acquisitions or CEO getting kicked out and replaced, it should be announced in the most public manner so that the companies usually disclose those information in SEC website in the United States. SEC is like a Security Exchange Commission, the central supervisor of this stock market. It's patrolling, policing that the companies are doing their good job in bringing those accounting transparency. Otherwise, the investors would be screwed up. So in SEC's website, edgar.gov, right, you will be able to find the real-time disclosures of those informations. So once they disclose it in the SEC website, it's a public information. At the minute of information disclosure, does the price reflect that disclosed information correctly? That is a question. Public information, okay? The third kind of information is insider information. It's secret, top secret. Shh. Like before a company takes over other companies, right? M&A kind of things impacts the price so much so that the insiders have to shut their mouth up to the outside world until it is finally agreed or it's disclosed, right, to the public. Let's say, let's shake hands and do it, okay? And that kind of announcement has to be done. But before that announcement, it's a top secret. That top secret insider information, is it get priced before the announcement? That means insider trading, okay? Does that get priced, okay? Is a serious question. So three kinds of information: past, public, and insider information, okay? Are they reflected? Is a question. And that leads to 3 degrees of progressively stronger notions of market efficiency: weak form, semi-strong form, and strong form. Weak form is about the past information getting reflected. Already, past information is already reflected in the price. Semi-strong form or public information is reflected in the price. Strong form says even the top secret of the CEO is priced. Okay, there's no secret. Oh my God. Is it? Can it really happen? You may wonder, right? But anyway, so let's go one by one from weak form efficiency. Okay? Weak form market efficiency. For here, weak form market efficiency has a lot to do with, right? Something called technical analysis. Technical analysis or 기술적 분석. Or Chartist, we say, Chartist. What do you mean? There are specific group of analysts who just focus their study on the price behavior. Okay, they don't care about what kind of news were released. Okay, information, okay, or M&A announcements, or CEOs, behaviors, whatever. They don't care. What they care about is the company's stock price chart movement, and it goes together with the our pattern recognition instinct. Okay, pattern recognition instinct. Well, it goes back to our million years of history of hunting, right, in the field. Okay, and those ones who are faster in pattern recognition, visual pattern recognition, were having higher chance of survival. For example, if you are a millisecond faster in recognizing, oh, that's the rabbit and that's the tiger, right? You must have had a better chance of having catching those prey or running away from the predators, so that you may have some better chance of survival. And over millions of years, we have survived in this way, so that systematically, we have strong pattern recognition instinct that pops up every minute. So we are good at pattern recognition, especially visual pattern recognition. Okay? The question is, that pattern recognition behavior shows up again whenever we see our stock price charts. And technical analysis guys are true to this pattern recognition instinct. Whereas the weak for market efficiency guy says, that's bullshit. All those pattern, it's useless, because it's whatever you infer from that pricing patterns should be already priced in the market. So by the time you realize, oh, there must be some ups and downs and ups and downs, everybody knows it, and everybody must have traded based on it, so that by the time you realize it, you're too late, man. So that you missed a chance already, because the market is weak form efficient. That's the story here. Okay. Now, Chartist, how can they go wild, right? These are the charts of the Bitcoins, right? And then, some Chartists were making fun of this, and then, you can draw a lot of pictures. Kiyoungi, this guy's name is Kiyoungi in Korean cartoon, okay? Raising his left hand upward versus downward, depending on that, you can predict where the price is going to go, okay? So his price is, left hand is up, so let's buy it. Left hand is down, let's sell it. That's what they do. Nudge, elephant, whatever. Yeah, technical analysis. These set of slides are pictorially explaining to you the contrast between the technical analysis and the weak for market efficiency argument, right? Essentially, that's what I said before. If the pattern that you recognized out of it should be correct, then you are not alone in recognizing those patterns, and market is fast and efficient enough so that everybody must be clicking the buy button even before you click that buy button, based on the pattern that you find. And then the price must have been shooting up to this place, the target price already, so that there will be no room for you to make money. Okay? And then the price will start to do a random walk. That's EMH, right? Efficient market hypothesis. And the thing is, the Chartist, right? EMH guys, right? The Chartist guys will always say, oh, if you look at this graph, you will find some support line and resistance line, so that the pricing will be, within this band always. But who says that it should be a resistance line? It could be, pricing pattern could have been like this. You never know, okay? The eyes in the beholders, right? The beauty is in the eyes of the beholders. So technical analysis, right, has a lot of, it appeals to your animal instinct. That's great. Sexy part of technical analysis. Everybody end up with technical analysis right before clicking the buy button or sell button, inevitably. But there's a limitation. EMH guy says, warning, right? Those weak for market efficiency doesn't make sense if the economics hold true. Okay? Now, the next thing is about, what is it? It's about weak form testing EMH, right? Testing EMH, weak form market efficiency. Does it hold true or not? And then the Eugene Fama and group of people were testing it in this fashion. Now, technical analysts, you guys said that you can predict the future movement of your prices by looking at the past price movement. That means past returns should have a predictive power for future returns. You see T and T minus 1. The dependent variable is, let's say, I stands for the company, okay? Identifier of the company, let's say Tesla's stock return, okay? And next day stock return of Tesla can be predicted by Tesla's past return, T minus 1. And then if that has a predictive power, just like what the weak form efficiency, just like what the technical analysis guys say, then this coefficient gamma, okay, it's not R, but it's gamma, this gamma should be significantly different from 0 if we take some regressions out of data, okay, based on this data. But if the weak form efficiency holds true, then this coefficient should be, nothing better, none other than, it should be close to 0. Okay, our null hypothesis, I should say like this: if you learned about this statistical analysis and statistical testing, remember those hypothesis testing? Oh my God, that terrible experience of type 1 error and type 2 error, so confusing. And then the hypothesis of null hypothesis versus alternative hypothesis. What the heck? We don't know. But hey, don't worry. I'm not going to ask you about this specific hypothesis testing, but if you remember it, right? This is equivalent like this. Efficient market hypothesis gives you like a null hypothesis that says the gamma should be equal to 0, and whereas the technical analysis guys would say alternative hypothesis, gamma is not equal to 0, and that gamma has some predictive power, right? And gamma should be either positive or negative, something different from 0 if you test it with thousands and millions of data points. That's what they say. Okay? Anyway, but Eugene Fama, okay, and his people in the researchers in 1970s, they found out this coefficient gamma, okay, is they could not reject the null hypothesis that the gamma is 0, right? So weak form market efficiency seemed to hold true, they said. That's what they found. But in reality, that's what they found in 1970s, right? With some limited data. But should it be true all the time is a legitimate question, okay? Because if the weak form market efficiency holds really true, why do we still have so many technical analysts in the market? The brokerage houses and investment banks and then a lot of hedge funds really look at these technical analysis, especially when they try to time the market and then click the buy and sell button. Okay? It's still there. It's 2020 and we still have so many technical analysts. And if you watch CNBC and the Bloomberg and Reuters, every now and then you will see a technical analyst coming up and advising you by talking about this kind of resistance line and then the support line, moving average, and things like that. Those are all technical analysts. They're not bullshitting. Economists always say they are bullshitting, but it's not. It has some significant predictive power. Moreover, I'm going to tell you later that there's a momentum going on, which means the trending, okay? Trend chasing works. Remember, if you think about this trend chasing idea, it's like this. If the prices start to go up for a certain period of time, it's going to keep on going up for another period of time, which means your future return is a function of past return. The historical information still has predictive power. The historical information is not priced yet. It's not priced yet, so that we still have room to make money. That's the argument of momentum trading. Whereas efficient market hypothesis would say whatever you can infer based on the historical pricing pattern, what you can infer, pricing pattern is this, and what you can infer is that, right? Standing at this point, you can predict that part. That prediction should have been already priced in the market today. Like, you're standing over here, target price is over here, pricing pattern that you recognize is here. You predict this to happen. If that is really the case, the price should have gone up at this point right now. You don't have to wait 1 month or 2 months like that. The historical price is already priced. The historical information is already priced. And then it will start to do random walk. That's EMH, weak form. But technical analysis guys and momentum trading guys, the hedge funds, find out it's not the case. It's not the case. It's still the trend goes long way. Okay, that's an interesting findings. And then that's bread and butter strategy for quantitative trading. Now, here's a quiz. If the market is weak form efficient, you can make money using candlestick chart. Is it true or false? I want you to take about 5 seconds and answer this question. Okay? And then let me move on to the next form of EMH in the next set of video. Okay, thanks for watching.